Good morning. It looks like our participants have loaded on, and so given that it's 10:30, we'll get started. My name is Grant Swartzwelder, President of OTA Environmental Solutions, and appreciate your time joining the Oilfield Strong webinar series that we've done. This is our 16th webinar presentation, co-sponsored by OTA and the Permian Basin Petroleum Association. Really appreciate all that they do for their membership and for the Permian Basin. This is going to be, I think, a very fascinating webinar. All of them have been, but this one I'm really interested in because small public companies have really driven the energy industry, I think, over the years, providing a source of capital, a source of growth. And now we've got quite a few changes in the energy industry that are going to be affecting that. We've got two great speakers for this presentation because they're right in the middle of it. We have Robert Anderson, who's President and CEO of Earthstone Energy, and we have David Fowler, President of Ring Energy. We'll have them both give a quick overview of their company and how they fit into the public markets, and then we'll go into a series of questions associated with that. As before, if you do have any questions, don't hesitate to send it through the bar down on the bottom side, and I'll get those questions slotted in to be asked also. If you do have any friends that might miss this and want to hear it, our YouTube channel is alive and doing well, and this will be posted in a couple of days for you to listen to as well. With that, let's jump into why you're here, which is to hear from our speakers. Robert, would you give a quick overview of Earthstone and kind of how y'all came to be public?
Sure, Grant. I sure appreciate being invited and interested to hear the questions and the comments from David as well. As Earthstone, this is our fourth public company as a management team. We tend to build these companies up and sort of act like private equity. And at some point when the time is right and not trying to time a market, we exit, return cash or shares to a shareholder, and then we start all over again. In this iteration, we started in 2012 privately, and then in 2014, we did a reverse merger into Earthstone Energy and took over management and operations of the company. And from that time, at the end of 2014, the energy markets have pretty much been in a downhill slide ever since. And it's been a very difficult environment for all of us, with some bright spots along the way where the markets were open and being a public company was what it was intended to be. And why we are public is because access to capital markets. In 2014, and I'm sorry, in 2015 and 16, and then early in 17, we got involved in the Permian Basin, and more specifically the Midland Basin. The majority of our assets are in the Midland Basin. Long life and resilient, as we all know the Midland Basin is. That's why we focus there. We're an operator out there now with about 30,000 acres roughly. We have a little bit of a different view of the world than the majority of small cap public companies, in that we are 60% owned by NCAP, but at the same time, we manage our balance sheet for the long haul, and we're here to survive. We've got low leverage metrics, and we've got great inventory, and as prices recover, we'll go back to running a rig and growing through the drill bit. In the near term, we're looking to grow just opportunistically through consolidation that will happen in this industry.
Thank you, Robert. David, could I ask you to do the same?
Be glad to. And as Robert stated, Grant, thanks for inviting us this morning. It's always a great opportunity not only to see you, but to participate in these webinars. Ring Energy was originally co-founded in 2012 by the co-founders of Arena Resources. They had started Arena in 2001, sold to Sandridge for $1.6 billion in mid-2010, turned around and started Ring. And I was kind of on the outside looking in during the Arena days through my Simplex Energy Advisors company that I had co-founded. And when Tim and Stan started Ring Energy, they came around and invited me to be a part of the company, which I jumped on. We rolled out in January of 13, And the focus was much like what Arena had done, and that was to focus on a conventional reservoir called the San Andres, which was a vertical play originally. Arena had drilled over 850 vertical San Andres wells, all for the most part in infilled locations. So basically going from 40-acre locations down to 20s, down to 10s, and in some cases even to 5s. So when Ring started, it was much along the same pattern. We had acquired some acreage early on. When we rolled out in 13, we started mid-year of 13 drilling vertical San Andres wells, again, which is a conventional reservoir, about 5,000 foot in depth, and had great economics, great returns, and continued on through the end of 14. Of course, all of us know what happened in Thanksgiving at the end of 14. And as we went into 15 and 16, we picked up another asset that was out in the Delaware Basin that was primarily a shallower play, much like the San Andres. It was about 5,000 foot in depth. It was called the Cherry Canyon. We felt that there was some brushy canyon underneath it, but we ended up buying that asset for $75,000. Had great infrastructure. We survived 15 and 16 because we ended up 2014 with no debt. So we got through 15 and 16 fine without any issues. We limited our drilling, of course, came out of 2016 changing from vertical to horizontal. There had been some changes in technique in the way that horizontal San Andres wells were completed. And as a result, the economics changed dramatically. So you had drilling costs coming down, you had EURs going up. So it was just exactly what you would want to see. So we began our horizontal drilling program at the end of 2016. We continued that through 17 and 18. And we've done the same thing through 2019 as well. It remains our focus. We ended up in the first part of 2019 acquiring the Wishbone assets. So our primary core asset is in Andrews and Gaines County on the Central Basin Platform. And the Wishbone asset is up on the Northwest Shelf, which is in Yoakum County. And that's turned out to be a great asset. We purchased that for $300 million. Would have loved to gone to the equity markets to have paid that off. But at that particular time, the equity markets weren't available to us. So we carry that debt today. We've got about $269 million I should say $369 million in outstanding debt, and which has limited our ability to see some of the cash flow that we'd like to see, because obviously we've got a fair amount going to interest expense, even though our interest rate is relatively low and that's the only debt that we have. But it has been a tough 8 years as you look back, as we look at 15, 16, as we look at 2020. And we'll talk a little bit more about some of the other factors that have impacted small public companies as we get further on into this webinar.
Thank you, David. Let's start off with access to capital, interest in E&P, small cap E&P. Kind of a softball question, because I think some of those are kind of obvious, but I'd love to get from y'all's perspective. David or Robert, whoever wants to jump in.
Well, I'll start, and I'm sure David probably has some of the same thoughts, but one thing for sure is that the oil and gas industry is going to be around a long time, and there'll be public companies of all sizes out there for various reasons. We think that size doesn't necessarily mean you're inefficient or a poor operator. There's proof in the pudding. You can go out and look at our presentation on our website, or David's presentation, or others out there. And small companies can be very efficient and very cost conscious and be very competitive on a margin basis. The lack of scale and size does impact in the capital markets. And it does make it difficult for the small companies to raise money in times like this. But that's part of the reason why we've always wanted to be a public company, is it gives us access to two different kinds of capital markets. Not only is it the public equities or debt markets, but there's also a private market out there that will do investing both on the equity and other financial structures for small companies, depending on what you're trying to accomplish. You're trying to go buy an acquisition, they'll team up with you and provide some kind of capital in different forms. So I believe long-term, there's going to be a small cap need out there for the investors who want to take that risk for capital appreciation with the smaller guys versus owning Exxon, which is a totally different type of investor. And we probably both have somewhat of a cult following based on our historical track record of being a small cap public company, both at the arena, now Ring, and us at Earthstone and prior at Geo Resources. We can show you investors who've been around with us for a long time.
You know, Grant, it's been interesting to see how the public markets have changed just over the last 3 years. When I look back, I think it started probably in early 2018, where a lot of institutional investors began to look at our industry and realized that the amount of money that they had pumped into us, $200 to $300 billion, depending upon the article you read, that they were expecting returns to come back to them, because they'd been investing heavily over the last 10 years prior to 2018. And as a result, they were expecting to see dividends. Of course, we were taking all those dollars and plowing them back into the ground and continuing to grow production. But as a result of that, we began to see institutional investors begin to pull back a little bit. And we began to see the capital markets begin to close. It was interesting too, at the same time, as energy was kind of beginning to see the bloom come off the rose, there were other industries that were beginning to flourish. Companies that were benefiting from some of the corporate tax breaks that we saw back in 2017. And as a result, investors were seeing other opportunities to see some good growth on their money. Well, it's been interesting to see the last couple of years. 2019, we saw personally, as a small public company, some market manipulation that was kind of disturbing to us. It was something that we were not expecting to see. But as the market began to change and we began to see the sector fall out of favor, it opened up kind of a lot of us became targets to shorting, and also something called naked shorting, which I won't go into, but it's just a method by which you can really push down a company's stock value. We saw ESGs become a part of investors' mentality. And as a result, we began to see fossil fuels almost kind of get pegged an industry that was bad. You know, fossil fuels were demonized to some degree, and I guess to continue to be. But I'll tell you what's interesting. Because of this webinar, I decided to do a little bit of research, and hopefully some people will find this interesting. I had heard numbers kicked around, but I looked at the S&P 500, and I wanted to see how the energy sector had compared over the years and compared to other sectors. And there's 11 sectors within the S&P 500. And if you look at 1995 to 2016, the energy sector averaged about an 8.9% sector weighting within the S&P 500. Interestingly enough, in June of 2008, we reached a peak at 16% of the S&P 500, which was only second to the tech industry, which is was at 16.8%. So you can see we're almost 1 and 2. If you fast forward to today, the energy sector is, as of February of this year, was 2.5% sector weighting. And as of June, it was 2.8% of sector weighting. So we saw a little bit of recovery over those few months in 2020. But it just goes, I think, to show you that the energy sector as a whole, with institutional investors and investors as a whole, it's dramatically changed. So there's not near as many dollars in our sector. The other thing too is we've seen a switch from institutional investors to more retail investors. And to Robert's point, you know, the reason why we're a part of the public landscape is because of access to capital. Well, we've all seen that somewhat dry up, not only on the Wall Street side, but also now we're starting to see more of that also on the bank side. But public companies small caps like us can tend to be pretty volatile. And to Robert's point a little earlier, for those first off, I think we're at the bottom of the market. You know, we're in a cyclical market. And I believe that we're at the bottom, and I think we're going to be looking upward as we see demand increase and we see some of these large inventory numbers start to roll off. Hopefully we'll get past the election and things will really begin to get back to normal into 2021. But I think that as a sector overall, I think we've reached the bottom. I think we're looking to come out. And for those, as Robert said, I think it was pretty well they can stomach it. I think that, you know, we're on the bottom end, and I think more and more people are beginning to look at us and say, yeah, this is a good time to get in.
Robert, David lays out kind of the negative trend for institutional acceptance, and you could probably say public market or public reception. How does that get changed? How does the industry or Earthstone kind of respond to that or try to counteract that?
So I'll take it you're asking a little bit of on the ESG side, and I'll go down that rabbit hole a little bit. Fortunate in this industry is that we're not the greatest champion of how good we are in the environment. We don't have a really good, and there are good institutional or good organizations out there, IPAA and API, who support us, but we don't do a very good job of educating the general public about how we operate in the environment and what good things we do every single day. We just don't talk about it. All of our careers, we've worried about hooking wells up to the gas line prior to completing them. It's nothing new. And in certain places, it's difficult because there's no infrastructure. So it takes a while, and we're out there with a growth mantra, and all of a sudden now we've got a bunch of gas that we can't hook up. Okay, we got to figure out how to do that. And we did. It took time, but we did. The same thing on oil gathering and water. And we all know that, you know, it's better environmentally to have less trucks on the road. You guys in Midland deal with it every day in terms of traffic and operational logistical issues that creates. And I see this as just an educational process. The other thing is, in the small cap world, not every company is created equal, but I know David and ours have a very well-aligned focus with investors on the G side, the governance side, and more on the compensation structures. And ours, I can speak to pretty candidly because it's all public. We align ourselves very well with the investors in that our long-term incentives, being stock, only get paid out beginning this year if we have growth in our stock price, not relative to a group or anything like that, which we've done in the past. So we've rotated from more cash and absolute dollars being committed to long-term incentives that are only applicable if the company does well, therefore the shareholder and the investor are doing well. So again, I think a lot of it has to do with education. I think we're doing the right things and we're getting better and better at educating. Some of the investment banks are spending more time talking to us about ESG and talking to investors about ESG and some of the good things that we're doing as an industry.
Oh, I think ESG clearly is a dominant issue. It was, and then it kind of went down the first part of this year just as pricing went, but it's always going to be there. Earthstone looks like they've been pretty proactive in providing ESG related matrix to the public. Is that kind of, I assume that's part of the strategy to get the word out?
Absolutely want to provide information to the public and kind of, you know, pat ourselves on the back because nobody else is going to do it. There's a lot of organizations out there trying to rank ESG and the E side of it and all that and all these statistics. Unfortunately, the proxy advisors use some of those and their own numbers, maybe inappropriately or not fully educated on how some of those numbers are working. But yes, we continue to highlight the things that we're doing because nobody else is going to bring that up. And so we need to educate the investors. Not only is it the investors, David mentioned a little word about the banking industry at the moment. We're seeing some of this fall into the banking side as well, and where banks in certain areas of the world are pulling back from energy investing because of the ESG. So this is a real thing. COVID kind of took the front page for a while. ESG is going to come back to being the front page here, I think, next year again. And so we're going to have to learn how to live with it. And that's what we've done at Earthstone is somewhat been proactive, not as proactive as the bigger guys. They have more resources and it's more prevalent at their investor size to be forward looking in terms of their sustainability reports and whatnot.
David, do you have kind of a take on ESG or something? How do you respond to that?
You try to ignore it, but it is not going to go away. Robert said, you'd love to ignore it, but it's not going to go away. It's an item that you've got to pay attention to. We're in the process of, we've addressed it to a small degree, but not anywhere near to the degree that we need to. The cool thing is we check a lot of the boxes on the E and the S and the G side. And we just haven't done a very good job, as good of a job as we can to make that more visible. It needs to be front center on your website. I think that as these rating agencies peruse the different websites, if it's not on the front page, front center, then that can impact your score. They don't want to have to go looking for it, in other words. But we've done a great job internally when it comes to, we don't produce a lot of gas to begin with because we're predominantly oil, or almost 90% oil. And so we don't have a big gas component. But that being said, it also depends upon who's buying your gas, what your options are. As Robert was saying, sometimes there's lines, sometimes there's not, or maybe you only have one gas purchaser. And if they've been around for years and years and years, they've kind of monopolized the area. If they have a line go down or a refinery that goes down, then you're shut in. So you're kind of left either do you flare or do you shut the well in? Well, obviously most of us are going to do what? We're going to flare because it's temporary. It's usually a week, it could be a couple of days. It's not very long. But we've done a lot of internal focusing on ES and Gs. And as a result, we've just got to be able to make that visible. And as I said, we're in the process of putting that together now. So it won't be long. You'll be able to see it front center on our website here pretty soon.
Sounds good, David. Let's talk about human resource aspects of small public companies, because I would think there for the longest, y'all could provide options and stock and growth and really bring in some people, the key folks that you need. Well, now it's, the whole industry is depressed, but now it's a little more stress is on the smaller companies. How does that affect y'all's ability to either recruit your team or to maintain your team of key personnel?
David, you want to start?
I'll be more than happy to start this time. And that's a valid point. I think that we've always used options as a way to compensate our employees for the good job that they've done over the year. And that's been a big part of our compensation package over the years. What's frustrating is when you see your stock price go from the high teens down to below $1. And you can see the impact that might have on an employee. I know how it affects me personally. It's something that concerns us all. We all recognize that this industry again is in a down cycle, and as a result, that's been impactful along with COVID and also the oversupply. But we've also changed the way that we're looking at that now. Instead of options, we've gone to grants, and that way it's far more lucrative to the employee that doesn't have an option price that it has to hit before they're in the money. So we feel like that's been a good move on our part. But we've been so thankful to have a really good core group of employees that understand the story, that have been with us long term. One of the things that we've always kind of bragged about is the fact that we don't have the highest salaries, but at the same time, we compensate our employees quite well. We've got great health insurance benefits to go along with that. But sometimes you've got to change your method, something that you've been used to doing for years and years and years. When the market turns against you, you've got to adapt to that. And we feel like we've done that, going from options to grants, and that's been, I think, a big benefit to our employees we've done that over the last 3 years.
This is one of the hardest areas of our business right now, given where we've come for this year. And we had to make some changes in our staffing, but much like David, we've used restricted stock or grants since we started Earthstone. We used options at Geo Resources, our prior company, but ultimately went to grants there as well. So at the field level, all the way to me, there's an incentive that is created and a culture that's created through giving stock. And unfortunately, these guys can sit there on their iPhone all day long and look at it just like we can in the office, or just like investors call us, and we get this daily or hourly report card, or minute by minute report card, you might say, compared to a private guy. And we have, thankfully, because of this culture, had people who have been around here for 20 plus years. We recently had a lady retire who had been working with some of our staff and our operations VP for close to 30 years, but under our management team over the last 25 years. So that culture, we feel, is the most important. And like David said, it's not just salary. We pay probably in the middle of the range of the Houston market. You have to attract younger people. You can't pay them $1 when everybody else is getting paid 10. So it doesn't work quite like that. But we've been able to attract younger folks, but the culture that we've created here, I'm learning these new words like work-life balance, allowing people to work from home a lot longer than maybe old school guys like to do. I mean, I've been around a long time, and I like the office environment and the culture, and being able to sit down and look at maps and have people around the table talking about whatever we're discussing, versus doing it, no offense, being a Zoom call or a conference call. One of these days, I think we'll get back to that, but we have allowed folks to do a lot of remote working. And again, creating that culture is the most important thing to attracting talent.
So you think you'll actually be able to get your employees to come back to the office at some point?
Well, this is live, so I have to be careful what I say. We are in the woodlands.
Okay, well, I won't have you
We are in the
answer
woodlands.
that.
So we're in
I think it's a
Montgomery
challenge
County,
for the
not Harris County. And we have reopened our office, and there are a few folks who still, because of childcare issues or school starting up or healthcare issues, are not in the office, but we're working safely here with masks when we're walking up and down the hall, and we have very limited meetings. So I think the folks are glad to be back in the office who can.
Yeah. No, I didn't mean to put you on the spot, but it's talk about another human resource issue of when do you have them come back? What do you allow? It's on a previous webinar, David Hayes with NGP talked about single asset companies versus companies that have assets in various basins. And as a small company or small public, whichever way, it's harder to have multiple areas. But it was obviously y'all are comfortable being focused, well, especially Ring in one area, and Earthstone's primarily focused in one. But how do you look at that versus, and kind of what the market is requiring and what the public folks are saying? It seems, there for a while, it seemed like the Concho Diamondback, those that are focused were really in vogue. Now it's kind of the diversified.
I'll just quickly give you an example of that, because I'm the diversified guy. I like diversification. It's a portfolio. And yes, I get it that the investor wants to be the guy who picks his portfolio. And so he's going to pick his Eagle Ford company or his Midland Basin or Delaware Basin or Bakken or what have you. My job is to, among many, is to deploy capital. And the best way to have capital allocation options are to have options in different basins at different times. In our prior company, we had Bakken and we had Eagle Ford and we had Austin Chalk. And when you couldn't get services in the Bakken or the basis differential blew out to where we were netting $10 and everybody else in the Eagle Ford was netting a much higher number, we deployed capital elsewhere. A couple of years ago, we saw the same thing in the Midland Basin where the differential blew out. We had very limited Eagle Ford assets that we could go drill at that time, and still do today in this lower price environment, but we had an option. And so we would spend a little bit more capital if we could in other basins under certain circumstances. I do get why the investor wants a pure play focus. But at the same time, we're capital allocation managers, and we're going to put our money in the best projects. And at times I just like to have optionality. And if I'm locked in and I can't get a frac crew in the Midland Basin, or the basis differential blows out, I've got some issues.
Robert, you said you can understand why they'd want a single asset, but I'd almost say that people are wanting diversity. What do you see out there? What's the institutional investors, are they wanting single or diverse right now?
Well, I think today they're less focused on single basin and they're more focused on free cash flow. I don't really care where it comes from. So
Yeah.
I'm not worried about single basin or anything else. I'm worried about free cash flow. So it doesn't matter today, right? It's the best assets win that develop the most amount of free cash flow. I'm thinking of it more from an exit strategy, and we, private or public, almost regardless of size, there is an exit strategy. There is a strategy you're thinking about: buy, hold, sell, right? And if it's the hold, it's probably the grow. If it's the sell, it's your exit strategy to be in the hands of a bigger organization that is better capitalized or lower cost of capital. So being a single basin at times has had its major advantage from an exit strategy.
And David, you're a single basin, but you're kind of split between a couple. And the interesting thing about what y'all do is you're not your typical deep, unconventional. You found some zones, some areas that are not of what everybody else is doing. And I think because of that, your operating expenses and others reflect that.
They do. And except for the Delaware Basin asset. That's a lot of times when you say the Delaware Basin, everybody's immediate thought is, oh, okay, so you're drilling the first, second, and third bone and also the Wolfcamp. No, we don't have the deep rights. It's all shallow rights. So we have some basically from 6,000 and above. And as a result, started out as a vertical play in the Cherry, but there's a horizontal play in the Brushy. We've drilled 5 wells in the Brushy and proven that play up. It's a little gassier, but it's still a very good high rate of return project. We're in the process of selling that asset. If all goes as planned, which looks like so far it is, we'll have that closed by the end of September. We'll take those proceeds and, of course, pay down our debt. But talking about our core asset, which is up on the Central Basin platform in the Northwest Shelf, which is the San Andres, it's a conventional play. You know, the San Andres is produced out here for 90 plus years. It's long-lived reserves. It's a shallow decline once you get past 4 or 5 years of 3 to 5%. Predominantly oil. It's a little heavier oil, more in the lower 30s, lower to mid 30s, gravity-wise. It's usually sour. Well, it is in all cases sour now. It's and again, predominantly oil, 85 to 90%. And because of the technique changes that we've seen really since 2016, it's really a high rate of return play. In a $40 realized price environment to us, $40 realized BOE, our rate of returns are right at 100%. So it's a great play. It's not flashy. We don't have the highest IPs, but when it just comes to meat and potatoes, really good returns, it is. You'll see subtle differences in the San Andres between the Central Basin platform and the shelf. A little tighter down on the CBP. It's a little cleaner, a little bit more consistent up on the shelf. We've really seen some great wells up there since we've even refined the amount of sand that we're using. We've increased the sand concentration, doubled it from last year. So we're seeing better IPs and better EURs. But going back to, we are a pure play for the most part once we get the Delaware sold. There's a lot of opportunity in our area to expand our footprint. We see some consolidation opportunities. We've seen that for the last several years. Unfortunately, other than the Wishbone asset, which added to our base quite well, is we see some other offset operators that are private equity backed that could eventually at some point in time see an opportunity to put our fields together so we can become of size. But it's overall, it's just a great asset. It's something that I don't think we have any intention at the present time to step out into the Midland Basin or the Delaware Basin to go into a deeper play. I think our focus is going to be remaining in that St. Andrews play, which is what we do and what we do well. And it's something that we did not only at Arena, but also are carrying forward to Arena.
David, you mentioned consolidation, and Robert earlier said about bolt-on or kind of add-on. So kind of looking at acquisitions and kind of the consolidation play out there, seems like there's some between debt levels, kind of some of the walking zombie type companies out there that have equity folks controlling it that, just would rather limp it along. How do you see that playing out? How do you see finding those opportunities and kind of help me understand how this market's going to kind of be consolidated or be acquired? And how about that as an easy question? Robert, you want to jump in, or Dave?
I think let me go ahead and take that one.
Okay.
We were levered up more than what we would ever typically want to be, because we are as debt adverse as Robert is. Matter of fact, a lot of our co-founders have a lot of the same mentality. And if it wasn't for the fact of the Wishbone asset being bought and the equity markets not being there, we wouldn't have the debt that we have today. We're working through that, and we've done, I think, a great job of remaining cash flow positive the last 3 quarters. We look at doing that going forward. There are going to be consolidation opportunities, without a doubt. I think that everybody realizes the bigger you are, the more cash flow you're going to have to be able to withstand whatever the markets throw at us. That, all of us want to grow. All of us want to be able to see our share prices grow. And as we look at the landscape, we see assets that we would love to have. And, but the timing is what is so critical. You can't get out over your skis. Obviously, to take on additional debt is not something we'd want to do. We don't have the luxury that Robert has. He's in a great debt position. Fortunately, we have a good hedge position that's helped us through this year. It's been for a lot of us. Matter of fact, I think, Robert, you've got a better hedge position than we do. But there's going to be consolidation, not just us personally, but when I look, when you look at Parsley, there's been a lot of talk about their ability to merge in with somebody. WPX, Callan. I mean, there's any number of companies that at the right time, and that's where I think that all of us are looking at redetermination coming up in the fall. We're looking October, November, so we need to get past redetermination. But I think once we do, and I think a lot of bigger companies are sitting back going, let's see how redetermination goes. Because there could be some opportunities when companies may see borrowing bases reduced further. Hopefully that's not going to be the case, but it could happen. So I think that some people are sitting back waiting, because a lot of them did that back in the spring, to see who was going to make it, who wasn't. So I think that as we look at the next 12 to 18 months, demand coming back, I think that it's going to set up, once we get past these next couple of hurdles, being the election, redetermination, that I think we could see a lot more activity going into 21 as we begin to see demand come back. People are going to want to try to negotiate deals in a lower market, which I think makes a lot of sense. And as a result, I think it's going to set up for a real active consolidation year next year.
Robert, do you have thoughts?
Yeah, the one thing I'd add is to David is we always know that this industry has an active A&D process. Now, it's been a little slow this year because of COVID and pricing and everything like that. And volatility is the worst thing for that market, but it does happen. And we're seeing a few things happening. And there's still a lot of private equity sponsored companies out there. And I'm sure, you know, you heard from NGP about some of the things they're doing to consolidate or, you know, control costs or cut costs, what have you. The same thing's going to happen in the public, but it may be a public to a private or a public to public. This industry has to continue the pathway of cutting out costs, and consolidation is the easiest way to do that. We need bigger, stronger companies, like David said, so we can survive times like this. Volatility isn't going away. It's probably going to continue at the same pace, and we're going to see a lot of upsets in prices. Let's just hope that it's 60 down to 40 and not 40 down to 20. But we're going to see that, and we've seen it before. And you've got to be prepared in the way you set up your company and capital to be able to survive. And I think there's going to be a lot of opportunity between now and the end of the year, and it's just going to get better next year as companies get tired of being in this lower price environment, and there's not a real good pathway to exit other than consolidation and using equity as the vehicle. And that's what, you know, we're very focused on, is using a little bit of debt, but also equity on any transaction we look at.
Very good. Thank you, Robert. Well, I noticed the time, and we went well past the 30 minutes, partly selfishly because I was enjoying talking to you guys and hearing your thoughts. So Robert Anderson, David Fowler, thank you very much for participating. To the attendees, this will be on our YouTube channel in a couple of days. Next week, we'll have a state representative from the Midland area. And then 2 weeks after that, we'll have Chuck Yates, formerly with Kane Anderson, to have some hot sports opinions on the energy industry as well. But thanks, everyone. Thanks again, David and Robert, for participating, and have a great day.
Thanks, Grant. Bye, David.